Now we will look at an essential part of business, and more specifically, marketing strategy. If you run a company or if you work somewhat high up in a company, you will have to think about strategy. You will have to think about how your company relates to its competitors. An important part of this is looking at a company's business portfolio. The business portfolio is the collection of businesses and products that make up a company. So for example, Apple's business portfolio includes iPhones in the smartphone business, Macs in the laptop business, but even Beats in the headphones and speakers businesses, because iPhones and Macs, they're products of Apple. But Beats is a completely different company, it's a different business, but they're still all part of the business portfolio. As a manager of a business, you will have to manage a business portfolio. To do this, you will have to carry out what is called a portfolio analysis. What is a portfolio analysis? A portfolio analysis is the process by which management evaluates the products and businesses that make up a company. Now there's many ways to do this. You could look at the profit of each product or business and invest in those that generate the most profit. But that would not be very wise. A much better way, a tried and tested method, is to follow what is called the Boston Consulting Group approach. But since consultants charge by the hour, most people just call it the BCG approach. The BCG approach says that you should divide all companies into 4 categories and give them a rating of either a star, a cash cow, a dog, or a question mark. Okay, so a cash cow is a company that has high market share in a slowly growing industry. This unit will generate more cash than is needed to maintain it, and they're usually boring and stagnant industries. They're called cash cows because they should be milked for all their profits with as little investment as possible. And there's little investment because it's a low growth industry. There's no growth, so there's no need for investment. Now on to dogs, or doggies if you want to sound nicer. These are units. When I say unit, I either mean a business, a division of a company, a business unit, a product. So units kind of encompasses it all. These are units that have low market share in a slowly growing industry. They're usually breaking even, generating just enough cash to maintain themselves. And this sucks, but they should be sold off immediately because they're worthless. From an accounting point of view, they're worth 0. Or they're almost worthless. If you're into accounting, they depress the return on asset ratio. But this is a marketing course, not an accounting course, so we're not gonna talk about depressing returns on asset ratios. Anyways, dogs should be sold. Next up, we have question marks, and some people even call them problem children. These are companies with low market share in quickly growing industries. So they're very tiny in an industry that is growing very fast. These could be startups, and they're usually a starting point for a business. Question marks have the potential to grow and later become a star. So basically, question marks are unknown, but they have potential. Stars. Yes, we all love stars. Stars are a company with a high market share in a quickly growing industry. These are question marks that are on their way to becoming market leaders. They're said to have a market-leading trajectory, but they could have also just found a profitable niche to be in. You don't know. In this case, they will be on a niche-leading trajectory. So market-leading trajectory or niche-leading trajectory. Stars will require a lot of funding to keep growing and to fend off any competitors. So basically, this is the BCG growth share matrix. What you have to do is divide all the companies or units into these 4 categories that we just talked about: stars, question marks, dogs, and cash cows. So once you've done that, you should invest in question marks and make them become stars. Then you have to fund the expansion of stars until they become cash cows. Once they're cash cows, after many years of milking and providing very good profits and a lot of cash, and like their market is closing down and it's ending, they become dogs, and you need to sell the dogs. So this is kind of a process. Every company is at a different stage. This type of portfolio thinking is very important in big companies, and it's vital if you're running a conglomerate. But some people think that conglomerates are economically inefficient. But regardless of what your company is, adopting a portfolio mindset is very important and can be super useful. If you have a balanced portfolio, you have stars with high market share that assure the future of your company. You have cash cows that are providing enough funds for you to invest in the stars. And you have question marks that might turn into stars for the very far away future. And hopefully you sell off all your dogs quickly enough so that they don't bog down the company and slow it down to a halt. Thanks for watching. Next time we will talk about strategies for growth and downsizing.